Hello, welcome to today's tutorial where we're going to look at how we can use the pension school model to calculate our capital gains tax liability in certain circumstances. So what I'm going to do today is continuing on from the example we did on inheritance tax. You'll see the model now has just John Smith left there, John Smith's mother has recently died, so we've just got John Smith left in the model, and as a result of the inheritance he's now got £413,000 in the current account, and he's inherited his parents' home, which is worth £482,000, or as it was valued in the calculation of inheritance tax in his mother's will. What we're going to do is assume that this home increases in value, and then we're going to look at how much tax we're going to be liable to pay. First of all, we'll also look at, if we look at display as income, we can see that his job is still a solicitor and he's getting £33,074 net. But if I just look at how much that is gross, and that's grossing up to £43,855. I'm going to leave his salary at that, but that's just to show what his gross salary is. So if we go into the fiscal pane here, we can see that is greater than the personal allowance plus the higher rate allowance, so he is just a high rate taxpayer. So what we're going to do now, we just move the model forward a month, and then assuming we then sell the parents' home shortly after that. But what I'm going to do first is I'm actually going to change the value of the parents' home, assuming we actually manage to sell it for more than it was valued at in the will. So I have to go into setup mode to do this, because you can't generally just change the value of a house as of will. It'll vary according to the economy. So I have to go into setup mode to do this, and I'm going to do change price per unit, and that there comes up with the current price of the house, as the same as we've got there, and I'm just going to assume it goes up to 600,000 in value. Now come out of setup mode. Let's just move forward a month again, see how things change a bit, or move forward another month, and you see the price is just varying now with the market movements. It's gone down to £596. So now I'm going to sell the home, so I select sell sum and sell 1.00 units of the asset, i.e. sell the whole of the home. We're not just selling half of it, we're selling the whole of it. So select that. Immediately the home's disappeared from my asset pane, and my current account has increased quite a lot. So if I put show bank statement, I can see here parents' home, I've received £596,000, £220,000, £226, and I've paid £11,000 in estate agents fees, which is 2% of the price of the home. Obviously the stamp duty will be paid by the purchaser here, so that doesn't come out of my account. So you can see there that there's no problem. Apart from the stamp duty, there's no other tax to pay at the moment, but we're going to look at how the capital gains tax works at the end of the year. So I'm going to step through month by month, and I will get to soon. I'll get an email from HMRC saying annual tax return. So I select that to see what the email says, and you notice the pertinent point here that we've made a capital gain of £100,919 during the tax year. So there's a capital gains tax liability of £25,289. Now if I think about it here, I've realised already that we're a high rate taxpayer, so we're going to pay 28% on our capital gain, and we're going to pay 28% on the capital gain over and above the capital gains tax allowance, which you can see here is £11,000. So we're paying 28% of roughly £90,000, which comes out at £25,000. So that's where our capital gains tax liability comes from. So I select OK there, and if I again look at the current account, I can see the tax liability there, £25,000, which is the capital gains tax liability for that transaction. Okay, so that shows how the pension school model will evaluate capital gains tax. You can also, if you've got an asset that's already in the system, you can change the purchase history, because that's an important part of working out what your capital gains tax is. In the purposes of this house we've sold, it's valued at the amount it was valued in the will at the time the asset was bequeathed, but in other cases it will be valued at the amount it's actually purchased for, and then the capital gain is the difference between the two. So however you've come across the asset, the pension school model can model how it is treated for capital gains tax purposes and calculate the correct amount of tax. Okay, that's the end of that short tutorial on how we deal with capital gains tax.